my name is Randy Lubin. I'm excited to be spending some time with you today to be teaching a bunch of different frameworks and models to use at various stages of your startup, but and just good things to have in your pocket as you're evaluating different alternatives. Hold on a sec. Can we get the reverb turned down a little bit? It's a little echoey. We'll see if that works. Yesterday we got some feedback that it was a little too echoey, so hopefully we can fix the AV. Anyway, sorry. So yes, we're going to be going through a lot of different startup toolkits and frameworks. These are things that I tend to use on a very regular basis when I'm talking to different startups. Because of the nature of this, it's going to be a lot of different frameworks that might not be linked together. And my focus is going to be more on giving you a sense of what the framework is about and how it works. And if you are interested in using it later, then you can go online and get a lot more information. But this is just to give you a flavor of it. Other than that, I'm going to give you a little bit of information about myself. I want to get a little bit of information about all of you too, and then we'll dive in. So first about me, so my path, about 5 years ago, I moved to the San Francisco Bay Area to attend graduate business school at Stanford. I got my MBA there, graduating in 2011. While I was there, I tried to take as many technology and entrepreneurship courses as possible, and I was doing a lot of consulting gigs with different startups. Every semester, I tried to do at least one consulting gig, helping startups out with their strategy, with their financials, and with product design and product strategy also. After Stanford, toward the end of Stanford, I started teaching myself to code, and after graduating, I continued learning to code, continued consulting for startups, and kept working on my own startup ideas too. Ultimately, I ended up joining one of my clients, a company called Meetings.io that did real-time video chat. The idea was to have just effortless video chat with no need to download anything, no need to even sign up or sign in, and then you're just face-to-face. And so I'd worked with the team in the past on a few consulting gigs, and when they were ready to launch, I joined them full-time. It was a really fun ride. We quickly grew to about 200,000 users, and before we knew it, we were getting acquisition offers, good acquisition offers coming in. And so we ended up selling the company in fall of 2012 to a company called Jive Software. They build collaboration tools for very big companies, for like Fortune 500 companies. And so I joined them. I spent some time there as product manager, and then also in corporate development doing acquisitions, partnerships, and long-term strategy. Let me go back a sec. So at Meetings.io, my role was business generalist. The co-founders, Dennis and Arnd, were both absolutely incredible entrepreneurs, very brilliant on the technical side, also smart on the business side too. But my goal was to keep them as much as possible focused on doing the really hard coding that was involved in video chat. So I was doing everything except for code, whether it be working with investors and lawyers, doing some of the marketing and PR, product strategy, pretty much everything. And because I taught myself to code, I was doing some of the easy coding so they could focus on the hard coding. So that was, yeah. I'm talking too fast? Yes. Okay. Yes. Okay. I have a tendency to do two things that are suboptimal. I tend to talk too fast when I get excited, and I get really excited about startup stuff. So if I'm talking too fast, just start waving your hands like this. I will slow down. Please, don't hesitate. Thank you, because I forget. The second thing I do is I'll use random Silicon Valley jargon and forget that not everyone knows it. So if I say something and you don't understand the term, odds are everyone else here also hasn't heard the term before. So please raise your hand and ask me about the term, and I'll do my best to explain everything up front. So thank you in advance for helping me. So Meetings.io, I was also doing some of the coding, the easy coding so that they could focus on the hard coding, and running lots of little experiments to try and figure out how we could best grow the company. From there, I was at Jive. Jive was fun, but I missed the startup life, so I quit about a year ago. I've been advising startups, working on my own ideas, coding on lots of little projects, and trying to figure out my next big thing. So that's about me. I want to know a little bit about you really quickly, just by show of hands. First off, who was at my talk yesterday? Raise your hands if you were here yesterday. Okay, a lot of people. So I have some stuff in here that overlaps with yesterday, but I'm going to skim over it very quickly. So cool. Second question, who is currently working on their own startup already? Okay, almost everyone's already has their own. And how many of you who have your own startup have launched it? Have already launched? Is the product already available for customers? Okay, a smaller number. And of those of you who have launched it, is it already generating revenue? Okay, cool. Excellent. So hopefully a lot of these models will be useful to everyone in the spectrum. Some are more geared to early on when you're just exploring, trying to see if you've gotten the right idea. And some are after you already have product market fit. And I'll explain right now, because I was using the term product market fit a lot yesterday before fully explaining it. So product market fit is a term often used in the startup world for that moment, that threshold that you cross once you know you've built something that people love and will pay for, or that you can get value out of, and that you'll continue to do so. So before product market fit, the idea is that you're experimenting with a lot of different types of features, types of products, types of messaging around it, and different types of customer bases. And then you get product market fit, and then you're worried about scaling. And all your focus is, how do I scale this into a really big company that'll stick around for a long time? So with that, this is something that was up yesterday. I don't want to spend too much time on it. This is from The Lean Startup. If you weren't here yesterday, I very much recommend checking out the book called The Lean Startup by Eric Ries. This core loop here, the idea is that you're jumping between three main activities: building, measuring, and learning. And that you want to be going through this loop as fast as possible, or as often as possible. And so that means, when you're building, you want to build the tiniest thing you can that can get you interesting information back about, have I built something that people love, that that really resonates with customers, and then making sure that you're getting good data off of that, and that data is something that you're able to learn from in building the next product. So that's the gist of this chart. This is the Lean Canvas. I spent the class yesterday talking about the different buckets of the Lean Canvas and how to work through it. I highly recommend using the Lean Canvas or something like it to capture all of your assumptions. The idea is that every bucket here is an important part of your strategy, but that every bucket is to contain a hypothesis, a guess, and that you're busy working on de-risking these hypotheses by going out and talking to customers and figuring out, are my guesses actually correct? So this is the first of the new frameworks I want to talk about today. This is one that my professor, one of my favorite professors in grad school, really liked. He was a famous investor. He founded Benchmark Capital, and then he went on to found his own startup called Wealthfront, which is a new way of a really easy way of doing investing that makes a lot of the hard decisions about investing very easy. And he's done a phenomenal job there too. And so the idea behind this, so it's a basic 2x2 where on one axis you can either be consensus or non-consensus. And what that means in this case is your idea for a startup, and let me take a step back. So this can be used for startup ideas, which is how I usually use it, but it can also be used for any type of investment opportunity, whether you're just thinking about the stock market or something else. And so the idea is, on one side you can be consensus or non-consensus, and so consensus means your guess, your hunch is what most people think, whether you're sort of in the majority and how you're thinking about things. And non-consensus is that most people will probably disagree with you. And then you can either be right or wrong. And so the idea is that up front when you're making your bet, again, whether it's about your startup idea or about or a stock pick or any kind of investment, that up front you don't know if you're right or wrong. And in practice, then, if you're wrong, then whether you're consensus or non-consensus, it doesn't really matter because it's not going to work out. But that if you're right in consensus, you're actually not in a great situation. So if you're a startup and you're right, but everyone else is sort of thinking along the same lines, there's probably many other well-funded startups that have the same idea and are working really hard on the same solution to the same problem. There might be really big established companies that are already starting to work on the same problem. So you might be facing competition from Google or Facebook. So the idea is that even if you're right and you're consensus, maybe you're going to be able to make something that's interesting that people will use, but it's going to be a really tough battle, and it's unclear if you're going to be able to capture a lot of the value. However, if you're non-consensus and you're right, that's where you end up figuring out something before anyone else does. You have the opportunity to create a really big company, really interesting company. And so something to be asking yourselves as you're working through your ideas, as you're trying to figure out what space you want to play in, what approach you want to take, is this something that a lot of people are agreeing with, that is something that's very consensus? And if so, you might want to reevaluate and step back. That's not to say you can't build a successful consensus business. There are lots of usually smaller businesses, so there's a term that gets thrown around called lifestyle business. So this is something that you might not accept venture capital funding for, that you might not want to build a gigantic team around. You can do that, but I think that's a lot less exciting because you're still going to spend a lot of time and effort working on that kind of idea. And in general, if you're going to be pouring a lot of effort into something, you might as well do it something that has huge upside that you can build to be really, really big. So again, you always want to be asking, is this too consensus of an idea? Is this something that everyone says, oh yeah, of course that's right? Because ideally, you want to be non-consensus, and you want to have, so there are terms that get thrown around by people in San Francisco, like, so you want to have a secret. You want to have something that everyone else thinks is wrong. And that's a sign that you might be onto something interesting. But the idea is that you have that secret because you're deeply authentic, deeply knowledgeable about the problem that you're trying to solve. So that's the first framework I wanted to talk about. So this next one is the technology adoption lifecycle. Quick show of hands, who's seen something like this before? OK, so some of you, I'll go through this. It's not particularly complex, but the idea is that there's a curve of customers based on how quick they are to adopt new technologies, new products, and that you need to know, based on where you are in timing the market, who you're going after. So the buckets in general, from left to right, you have your innovators who will try anything, even if it's horribly broken, even if you've just put it together with tape and rubber bands. Then you have your early market, who are a little more, they need to be a real product, but they're still willing to take a gamble and behave in new ways. And then after that, in the center, you have the majority, and that's like your everyday people, your people who are just normal people who aren't technology enthusiasts, but once an idea is shown to be a safe idea, safe product to use, one that makes sense, they'll jump on board. And then beyond that, you have laggards, people who are really slow, that just hate accepting new technology. So anyway, this is just a way of thinking about how all your users, how all the possible users in the world for your product fit along a spectrum. And the idea is that early on, you want to do things that don't scale in order to just get those innovators, get those early adopters, because they're going to give you all the good feedback you need to make sure you're even building the right product. And so one of the interesting things that emerges from this is that there's this chasm. So Jeffrey Moore is the guy who came up with this concept and came up with he has a book called Crossing the Chasm, which is very good and worth reading. And so he says there's this huge gap between the early market, which is the innovators and the early adopters, and jumping from there to the majority, and that they're fundamentally different types of people. The people that are really open to new tools and new types of solutions, and the people that are a little more conservative, and that you have to be really clever in how you jump that chasm. And so he has a model I really, really like called the bowling pin or bowling alley model. So I'll jump over to here. And so the idea behind the bowling pin model is that you really want to think of your overall market as having lots of different smaller customer segments, all of whom have different characteristics and different needs. And that one really good approach is that, so you break them out into segments, and for the first segment, for each segment, you can have a different group of customers and a different set of features. And so the idea is that you choose your first customers that you know you're going to have an amazing product that they're going to love, that they have a pain point that's just not being solved, and you build for them. And once you build for them, once you try and get everybody who looks and feels like that customer segment, and once you're doing a really good job there, the question is, who do you go after next? And you can do two things, and you can do them simultaneously, or you can do them in sequence. But you can find somebody a different customer segment that's just like different customer segment than the first group, and try selling them the same set of features and products. And that can be really effective, especially if they're a little more conservative in adopting things, or they just require different messaging. So that's one approach you can do after you get your initial market. The other is take your initial group of users and then build a second product or second set of features that you think they're really going to value. And the idea is that as you're going from just your initial product that might be really scoped down, really small, you start going out in these different ways. You start adding new groups, and you start adding new features. And the reason it's called the bowling alley or bowling pin approach is that it kind of looks like a bunch of bowling pins going out, where you go from just first user base and first feature set to second group with the first feature set, and the first group with the second feature set, and then you just keep going up and up and up. And so I really like this in terms of thinking about what are the different segments, what are the different clusters of feature sets, and then it becomes really important for exploring what is that first bowling pin, what is the first customers, what are the first feature sets, and the way of picking that could be based on how easily you can get those customers, how close they are to other customers out there. So one group might be more attractive than others because you know that once you get them, you're going to be able to immediately go to some other groups nearby and be like, oh, look how they're using it. You can use it too, but in a slightly different way. So that can be really exciting. And you can also do it based on the feature set of saying, oh, this is a feature that, this is an initial product we can build in just a weekend. Let's start with that and then grow from there. So again, a really useful tool for this, thinking about how you sequence going after users, how you sequence adding features. And something I'll throw out here, when coming up with the initial feature set for your product in general, whether you're using this approach or not, I am the biggest fan of just scoping down as much as possible. So the joke that will often come up is, when you're coming up with your list, write your list of features that you want for your initial version of your product, and then cut it in half, and then probably cut it in half again, and for good measure, cut it in half again, so that you're just down to like fewer features than you ever thought important. And the point behind that is, one, you want to get something out there as fast as possible, because every week, every day that you don't have the product in customers' hands is a day or a week that you're not getting important feedback, and it's a day or a week that you might be building something that nobody cares about. And so by starting with really few features, you're going to learn that very quickly. And it also helps because there's this instinct that I've encountered before, that I felt myself and that I've seen other people encounter, in that when you're putting your product out there, when you're building something, you want it to be amazing, you want it to be perfect, you want it to wow people, and that perfectionist instinct, while it can make you really successful in some cases, more often than not just means you're preventing yourself from getting feedback. So that's why I'm really in favor of releasing something when it looks really ugly, when it's like not the perfect set of features that you know, but that you just get it out there and you get feedback.
So how actually you do it? First you build up your first segment, and then from your first segment, the first segment will tell people to get your second, third segment, or from the first segment we can like categorize them for our third and second segment.
Sure. So the question, let me make sure I have this right, is how do you start expanding from one segment to the next segment? So some of this depends on what type of market you're approaching. So if you're in the enterprise world, oftentimes what you'll do is, when you're approaching each segment, you want to find what's called a reference customer. And a reference customer is someone that everyone in the space respects and trusts. They might be a really good brand or a really good team. And it is that you work really hard, you spend extra money and time trying to lock in that reference customer, because then you can go to everyone else in the space and say, hey, look, they're using it, they're buying it, you should too. And the idea is that you should also look at segments where, even though customers might be in different segments, they still respect people in the different reference segments. And then again, depending on your market, if you can get a referral, if you can talk to, let's say again, this is an enterprise example, you can talk to the CEO and ask of an existing company and say, hey, would you mind making an introduction to your friend at this other company, or would you mind coming along with me for a sales call? That could be an approach. If it's a if you're talking something more consumer, let's say you're building a more versatile app that can be used in a lot of use cases. It could be that at first you have the app, same app, and it's only being used for one use case, and then you want to add use cases on later. It could be that the later use cases have some overlap between your existing customers and then their new customers that only want the new use cases. Then you can go after existing customers that actually like both use cases and start saying, hey, I know you're using my app just when you're at home. Would you consider using the app when it's at work too? I would love feedback from you at that point. And so that, whenever you can use your existing customers to get better feedback, better insights, that's awesome, because one, you already have the relationship, so they're likely to be more open and spend more time with you if you've built something that you've loved, that they love. And that also, this is information that sometimes your competitors can't get because they don't have if they're starting out from scratch, they don't have the initial customers. So having some loyal customers early on that are going to be that can give you great feedback is one of the best tools, best assets you can have. So definitely cultivate those early relationships and spend time with them in ways that you'll never have time to spend with customers once you start scaling. Okay, next thing I want to talk about, and again, this is something that you can spend tons of time talking about, but I only want to spend a little bit of time talking about, which is market sizing. One trap that I see a lot of startups fall into is building something that they're really passionate about or that looks really cool, but that there's just a limited market size for. So one of the most important things you can do when you're just you're starting to explore startup ideas, is get a good grasp of how big the market is. The picture I have up here has a few different terms thrown around. There's total addressable market, served available market, and target market. You can use these terms, or you can use your own calculations. The idea is that at the largest scale, you have, okay, what are the total number of customers that might ever use my product if I take over the entire market? And this is a number that you can calculate from sort of the top down, looking at, okay, let me look at the entire current economy and how much of global spend is happening in this part of the economy, and how much of it is spent on the specific problem that you're working on. That's one way of doing it. A bottom-up approach is usually better, where you say, okay, I think that there are 10,000 companies out here who have the problem I'm talking about, or maybe there are 30 million consumers who have the specific need that I'm trying to target, and then go so that's at the biggest scale, and then you want to start working down smaller and smaller to have a sense of what's realistic for you to attack first. So it could be that this many people are in this space, that maybe 30 million people are in the space, but only 15 million of them have the problem to a degree that they're really willing to spend money on it, and then maybe only 5 million have the budget to spend money on it soon, and then maybe going back to the technology adoption lifecycle earlier, maybe only 1 million of those people are traditional early adopters or innovators that I can even begin going after now, or that I have access to now. And that's how you go from a really big market down to what's addressable today. And the trick is, well, on one hand, you want to make sure the initial market is really big, because if the initial market isn't big, then you're going to have a really hard time getting profitable, because even in huge markets, or markets of any size, it's hard to get a ton of market share, hard to get a big percentage of the market that you're going to own that relationship and own the sale for. And so you want to make sure the market's huge, because that has a few benefits. One, it means that even if you don't take over the whole thing, you're still going to look pretty good. And also that there are probably interesting subsets of customers within that market that you can just target first and deliver something that's really, really amazing for them. And so again, lots of benefits for going after big markets. Also, if you're trying to get outside investments, investors aren't going to be interested unless it's a huge market. Again, for just that reason, that startups are hard in general, and that at least if you have a big market, you can hopefully just get a slice of it.
Can I ask a question? Hi.
Yes.
Hi. Can you give an example of how you calculate, like just, this is a very classic consulting question about estimation and all that. If you can walk through a real example of, say, I'm in the business of selling, someone came to me yesterday and said, I have a business selling to car tuners.
Like cartoonists, or
no,
people who tune up
car
cars?
Tuners.
Okay.
who create rice rockets and like pump up their cars. How do I estimate the market for that?
Sure. Thank you. So great. So again, to reiterate, so we're doing market sizing for car mechanics and car tuners, and we're trying to figure out just how big that market is. And so the first thing I would try and do, this is a great case for doing a bottom-up approach, and so you want to become very familiar with the statistics around car tuners in whatever market you're approaching. So in this example, are we talking about Malaysia, Southeast Asia, the world?
That's a good point, actually. Well, so I think a lot of people here tend to just estimate the Malaysian market, but what we're trying to say is that they should estimate the Southeast Asian market, right? And the Southeast Asian market has 600 million people. Malaysia has 30 million people, just so you know. And so I guess the first step, I guess there's two parts to it, right? Because if I'm thinking about pitching to an investor, first I'll tell them about the car tuner market or car mechanics market in the Malaysian market, which is day one, like today, and then, but in 3 years, I can grow to Southeast Asia, and here's my Southeast Asian market.
Yeah, so one thing I want to call out that Charles just said, which is great, is when you're talking to investors in general, and when you're coming up with your own plans, it's really good to keep jumping between the practical roadmap of here's how we're going to get our first handful of users, and here's how we're going to get our first 1,000, 10,000, million users, and also, at the same time, the very high level, when we conquer the entire market, here's the whole overall opportunity. So you want to have a grasp of both those numbers. So again, walking through the model, what you might want to do is saying, okay, if we're just starting in Malaysia, let's look into maybe the records are in a government database or online, or there's some directory of all car tuners out there, and you can say, okay, well there are, I don't know, maybe 30,000 car tuners, for example, in Malaysia, and then you can say, okay, well the problem I'm trying to solve is with a specific type of car tuning, and this happens. And this is something that either you can find out information online of how much business these car tuners do and what percentage is related to what you're doing. And so maybe you could say, car tuners are a, $500 million industry, and we think that what we're talking about is relevant to maybe 20% of their business. Then, okay, we're now talking about 100 million in total spend for car tuners on these types of activities. And so you can say, okay, well, in Malaysia alone, it's a $100 million opportunity. When you look at overall Southeast Asia, maybe that number ends up jumping to $1 billion. And so suddenly you have a good grasp of overall market size there. Another approach might be, and so it all depends again on where you can get your numbers from. But it might be, you might say, okay, well, there are, say, 15 million cars owned by Malaysian drivers. I have no idea if that number's true. 15 million cars owned by Malaysian drivers. These cars need to go in for this type of tune-up every 2 years. So that's 7.5 million cars going in for a tune-up a year. And so you can say, okay, well, 7.5 times, well, we think we can end up, this is something that people are currently spending, say, $15 per tune-up on. So then you start doing them, or let's say 10 then so now we're talking about $70 million being spent a year. And now we've arrived at it not based on car tuners, but based on overall cars. And the idea is, it's more art than science when you come up with these market sizings, and you want to triangulate on the number. You want to try and come at it from a few different directions. So maybe you want to say, let's look online at the records for the total number of car tuners and work at the market that way. And then also say, okay, let's look at the total number of cars and come at it that way. And you can do these both based on, based on online information, but you can also just pound the pavement. Just go to a handful of local car tuners in this case, talk to the people there, and make sure that the way you're thinking about them spending their money is how they think about spending money. Because otherwise, you risk building something that, while it looks right on paper, nobody behaves in that way. So.
Okay. Basically, the definition of market is the people that. Sorry. Yeah. Hi, I'm Desmond. Okay. The definition of market is people that paying, or the people, the number of users. That's the first question. And I will assume is the people that paying, right? Okay, the second question is, it seems that the SAM and also the target market to me is about the same. So how to actually really differentiate these two? To me, both are actually my sales people are actually targeting, and yeah, so how to differentiate these two?
Cool,
that's
thanks.
my question.
Okay, so the first question is, again, to reiterate, is are we talking about total market size in people or revenue, or how are we thinking about this? And so traditionally, you're thinking about it in terms of total revenue or profit opportunity, but you should have all of these numbers sort of in your pocket. Investors, you should easily be able to say to investors, so using the car mechanic example, well, there are this many drivers, or there are this many cars, but you should also be able to say, there are this many mechanics. Then you should also have a really good grasp of, this is how much money is spent every year by mechanics, and this is how much money is spent on tuning by customers. And in doing so, you just end up having a really good grasp of where are the different opportunities to play within the market. So they're all really important, but overall amount of spend is really good, or even better if you can get to how much profit is made, then that's even better. But usually you say, okay, customers are already spending, $30 million or $100 million in this segment. So your second part, what's the difference between the served available market and the target market? It's nuanced, and again, this depends. As I said, this is one way of looking at it and breaking it down. It might be more useful to just have two. So served available means how many people can you realistically be targeting with the ways that you can reach them. So in this case, it might be that with the car mechanics, it could be, okay, so there are, out of the 100% of car mechanics out there, maybe 50% of them are organized into bigger companies of car mechanics that you can actually target with salespeople, and the rest are all owned by one person that it just doesn't make sense for you to go out and go one by one to try and get them down. So in this case, maybe the served available is about half that size. And then in this case, maybe target market is you're saying, okay, I'm going to start just instead of going to 14 states, I'm going to start just in the 3 states that have the most number of cars and car mechanics and that have really good industry groups that I know I can just go to one conference and meet most of the important car owners. So that's one way of breaking it down. But again, I wouldn't follow this. I wouldn't feel the need to make sure that you had all 3 of these broken out. It's more about make sure you know at the biggest end, if I get everyone, how big is it? And then where am I starting out? Who's that first group and how big is that? And then the next, and the next, and the next. All right, next up we were talking about customer lifetime value. So Cheryl started talking a little bit about this as an important metric to get a grasp on. And customer lifetime value is how much your customer is going to be worth to you over the entire time they're your customer. Customer lifetime value is an equation that if you, I recommend looking it up online. There are many different ways to calculate it that take in many different factors. But most importantly, again, you're just trying to get at what are they worth to you over the entire time that you have them. And this is really important for a few reasons. One, when you're trying to figure out how big of a business can you build, you want to know how much you're going to earn per customer. And two, once you know how much money you expect to make, how much profit you expect to make per customer, then you know how much money you can spend to get the customer in the first place. So I'll walk through a quick, this is a very simplified look at customer lifetime value. You can get ones, I'll talk about the more complex flavors of them in a second. But in this case, you can calculate, okay, for one customer, how much profit am I making for the sale? And sometimes that's really easy to calculate. Sometimes you have to expand it. So you say, okay, they're paying me $100, and then my direct cost is maybe $50, but then I have a support team that I need to pay, and maybe that's going to end up being about $20 per customer, so my profit's only $30 per customer, or something like that. And so, or sometimes if you're building an app or a website, it becomes really easy in that there's no extra cost for an extra customer. That's one of the amazing things about building websites and apps. And so in that case, it's all profit. But that's something you need to figure out. So what's the profit per sale? Then what are the number of sales per month per customer? Again, sorry, so let me make clear, this is all on a per customer basis. So it could be that you're selling something to your customer that you're making $100 on. We'll work through numbers in a second. And then the final thing you want to look at is how many months do they stick around for? How many months do they continue being a customer? And you start out with, again, like maybe this is just a guess before you actually have them for a long period of time. Maybe you can find out numbers roughly based on how long they stay competitors, or there's just other similar behavior you can look at to see how long these customers stick around. Once they become your customers, you can actually be tracking and say, okay, well, on average, a new customer will stick around for 3 months or 6 months or 12 months. And so you multiply these all together and you get their lifetime value. So a simple example, it could be that one purchase, is probably about $100 in profit. So again, maybe they're paying $200, but 50% of it goes to costs. Then maybe they're sticking around for 2 months, and maybe they're making 2 purchases a month, and maybe then they're sticking around for 12 months, and that gets you to a total lifetime value of $2,400. And then you can start being clever and say, okay, well, if they're going to be worth $2,400, then that's a lot of money I could spend on marketing and advertising to attract them in the first place. And you can start doing experiments, whether it's on Google AdWords or let's say you're doing an enterprise software and you're building up a big sales force. Then you can say, okay, well, let me think about this. If I have to hire a salesperson and my salesperson costs, say, $50,000 a year, then let me do some math. Again, maybe using some of the estimation methods that Cheryl was talking about to say, okay, well, if a salesperson can make 10 meetings a week and maybe 2 of those meetings become customers, then now that's roughly 100 new customers a year. So for a $50,000 salesperson divided by 10,000, oh, that's pretty good. It's only what is that, $5? I totally missed the math on that. Whatever. You'll end up figuring out roughly how many customers a salesperson can get, and then if the amount of money you're making for the customer is bigger than the salesperson's salary, then that's great. Then you can just hire a lot of salespeople to go out and immediately start getting customers. But if you end up doing the math, and let's say the salesperson is $50,000 in cost, and your customers that one salesperson can get are only worth $40,000, then you probably can't afford the salesperson, and you're going to want to try different channels to get your customers. So again, customer lifetime value, really great for just figuring out in general how much your customers are worth, and for figuring out your total opportunity if you know how many possible customers that are out there. But also really important for figuring out what levers can you pull, what channels can you use to get customers, how expensive, how much money can you spend. A common way of doing this in consumer-facing startups is if you're spending money on Facebook ads or Google ads, saying, okay, I'm willing to spend $10 on a Google ad because my customer is going to be worth $15. All right, so before I move on to the next topic, I just wanted to call out some ways this can get more complicated, but not actually walk through them now, just things to think about. So so one thing you can look at is for each customer, how many other customers do they invite? So that's virality. So in that case, even though one customer's lifetime value might be $2,400, if for every 2 customers you get, one of them invites someone else, then you get to add an extra $1,200 to this overall value. So that's really nice. Other numbers that get thrown around here, so discount rate. Are people familiar with the term discount rate when it comes to finance? Quick show of hands. Okay, discount rate. So a few hands. And so discount rate comes to around a term called time value of money. And the idea is that $100 today is worth much more than $100 5 years from now. And figuring out exactly how much more valuable that is comes down to a few factors, but including if you were to invest $100 today, how much would it be worth 5 years from now? But that as a company, in certain spaces, you end up caring a lot about time value of money and how much more money is worth today than tomorrow. And so that even if a customer is going to be around for 5 years and spending a lot of money each year, the money they spend 5 years out is worth less relative to today, that you're less concerned about the money far out than today. So if you're doing a more complicated lifetime value and you're in the right relevant industry, you might want to take that into account. You also want to be taking into account another way of, there are more complicated ways of formulating customer lifetime value that take into account churn rates. So instead of saying how many months are the customer around, you say what's the probability of the customer leaving every month. Yeah, turnover rate. So there are a lot of ways of calculating it. Early on, I think it makes sense to go with more simple ways, because again, there's so much uncertainty in the actual numbers that you just want to get some assumption on there that you can start checking. And then as you get more sophisticated, as you get further along, you can use the much more complicated formulas. I'm not going to walk through it now because it's not relevant for everyone, but I highly recommend looking it up online. Okay. For customer lifetime value? Yeah, you want really high customer lifetime value in general. Always good to have a high lifetime value for the customer, because that represents the entire amount of money that's going to be coming in from the customer per customer you get. And so you want high customer lifetime value and low customer acquisition cost. So usually like the equation you want to be looking at as you're figuring out who are the customers we're going at, what are we charging them, and what ways are we acquiring them. You have customer lifetime value, and then you subtract customer acquisition cost. And that's where you get what's the actual amount of profit after cost of getting them per customer out there. And that number, one, you want to be positive, and you want it to be as big as possible. So the next thing I'm going to move to is AAARR metrics. Yes?
Is this talking about revealing? Or the lifetime value is talking about revealing as well?
Revealing.
Rebuilding.
Oh, rebuilding.
Yeah, rebuild.
Rebilling, yes. Yeah, so the question is, does lifetime value of a customer include rebilling or reoccurring revenue?
The service, let's say it's a service that is one-time billing. Let's say I'm offering a service, but only one-time billing. It's $100. That's lifetime value of $100.
Right, so yeah, so a couple, okay, cool, let me go back. So yeah, so one first instance, it might be that, this is an app that's going to be purchased once, but never purchased again. Well, so your lifetime value of the customer is probably just whatever the cost of the app is. But then maybe you build in some virality and things that encourage people to tweet about it or share it with their friends through email, and then you know that for every customer who downloads it, you're going to get 2 additional customers, then customer lifetime value is maybe $300 or 3 times whatever the cost of the app is. So that's one way to look at it. Another way, if this is a software subscription service, there's probably 0 when it comes to how many, there's only 1 in terms of how many times per month they're doing it, and then the number is, okay, if you're charging people $50 a month, again, how many months do they tend to stick around for? And so that's the calculation you want to be doing. And another thing to think about is also payback time. And payback time is how many months does it take to get back the costs you spent getting the customer. So if it costs you $100 to get a customer, and then you start making back, say, $50 a month, that's great because they've paid for their initial cost after 2 months, and everything after that is going to be profit. Is just great profit. And so, especially early on, you can come up with very ambitious, very optimistic goals for what the lifetime value of the customer is. But if a lot of that money is coming down the road, then and it takes a long time to get your money back, then you have to suddenly worry about your cash flow. And do you have enough cash to last until you get your money back? And that's something we're going to talk about a little bit later. Okay, so our metrics. So Dave McClure, was an early guy at PayPal, and then started 500 Startups, the super angel or VC arm. He has this nice presentation he has online, which I encourage you to check out, where he breaks down a funnel or a pipeline of looking at all of your customers. And so it has 5 key parts, and we'll talk a little bit about all of them, but this is all a sequence that your customers go through. So for acquisition, so you get them to come to your site for the first time. Activation, you get them to do something interesting on your site. You get them engaged. Maybe you get them making initial purchases if there's something to purchase on your site. Retention is about keeping them around. Referral is about getting them to tell their friends and increase virality. And then revenue is getting them to actually start paying. And again, if we're talking about an enterprise company or subscription service or one-off purchase, this funnel is going to look different. But the idea is that come up with a version of this funnel that makes a lot of sense for you. And the idea is that at every part of this funnel, people are going to drop out. So there are people that are going to come to your site, but that they're never going to use the site. There are going to be people that are going to use the site once, but not stick around. There are people who are going to stick around for a while, but never tell their friends. And there are people that are going to use it a lot, but never pay. And you really want to see how that funnel goes down and down and down. So here is an example of his slides. It's a bit of a mess, and for people sitting more than in the front row, it's probably a little hard to see. I'll just call out some of the different parts of it. But the idea is that for each of these buckets, there are many things you can do to increase the number. So again, for every step of the way, you want to know what percentage of people start dropping off. And so with acquisition, you can get people coming into it through lots of different tricks, through content marketing, through publicity, through search engine optimization. So you want to try lots of different levers to see, based on how much it costs you to get customers, how can you get a better percentage of people coming in? For activation, it's about having really good analytics on your homepage to know, OK, of people who arrive, how many people just immediately leave versus create an account or whatever other metric is important to you. For retention, it's about experimenting with emails that you send out or different reminders. And so again, as we're talking about these different buckets, they're all areas where you can conduct lots of experiments and say, how do we get these numbers better? How do we get them going up? But more important than just conducting the experiments, or equally important, is making sure that you have these numbers captured and that you're communicating them with your team so everyone knows a snapshot of where are we today in terms of where are we losing people and where do we think we can get the most return from spending our time and spending our money. So I'll call out, again, traps startups can fall into is just focusing on acquisition, just focusing on how can we get more customers, without thinking about how do we retain them. And so it could be that you get lots of customers, but they quit after a month. And so that can be, that doesn't really help you then if you're just getting customers and immediately losing them. Or likewise, it could be that you're really focused on just retaining customers. And maybe early on, that makes a lot of sense, because if customers aren't sticking around, you probably don't have product market fit. You probably haven't created something that people really love. So early on, it might be OK to focus just on retention, or activation and retention, and then later on go in and focus on acquisition again. Let me see if there are any other specific things I want to call out here. There's just, again, I suggest looking at, again, some of the examples online, some different levers you can pull. But again, this is something that you should be tracking, and you should be conducting experiments around every part of. And so here's some example metrics just to show. So at your own startup, you might want to create a table like this that has the different steps. And again, your steps might be a little bit different than these steps. And have your percentage conversions. So saying, OK, let's say of 100% of people who hit our homepage, in this case, 40% immediately disappear. They immediately hit the back button. Then of the people who end up sticking around and creating an account, maybe 15% of them actually come back after that and stay engaged and start working. And then in this case, 5% of people are retained, and 1% will refer other people, and then maybe 2% will end up generating revenue in the end. And again, for every step of the way, in this case, they say, OK, well, if the person at the end is going to be spending $10, maybe that's the customer lifetime value. Let's work our way backwards and say, OK, well, for everyone it takes to get to our site, that's only going to be worth 5 cents because of how much drop-off there is between the first time they come to the site and they get revenue. So again, having this type of funnel, having this percentage basis is really great because, again, you know how much you can spend to get users. So we're just talking about customer lifetime value. If, let's say, customer lifetime value is $10, that would be, you start thinking, oh, that's really exciting. But you don't want to be spending $10 to get just any user. You want to be spending $10 to get someone all the way through the funnel. So that means that, in this case, to get somebody coming in for Google, you wouldn't want to spend any more than 5 cents per user coming in. A question in the back.
Yeah, can you talk a little bit about the same idea, but kind of offline, how to monitor the analytics for activation, retention, and that kind of thing? Is there a simple way to kind of put that together, or is it just a matter of taking your offline numbers and putting it into a spreadsheet?
More the latter than the former, putting it into a spreadsheet or tracking it in creative ways. Do you have a specific business you're thinking you have in mind?
Basically, it's a sports program. It's a social sports program. integrating things that are on the website and off the website, and kind of how do you put it together?
Got it. So again, for people who didn't hear, we're talking about an offline sports related service, and that a lot of the activity ends up all happening offline, even though you're first getting the users through social media. And so what I'd say is really important in this case is having the one online dashboard that everyone on the team can look at that has every part of it. And so retention numbers, even if they're just back of the envelope, you want to have something, because again, some data is better than no data. And if it starts looking like you're doing really good at pulling people in and you're unsure about retention, then you might want to spend the extra bit of hours or money actually getting a good sense of what that number really is, because that becomes really important to the business. So in that case, maybe it's about going through all of a huge stack of paper records, just seeing who's signed up or who's signing up again, or whatever the more manual thing is, then it becomes really important. Or maybe there's something easy to do that just captures digitally, who's coming back. Maybe you just create a very, very simple like half-day hack of creating a little like web form site that tracks people as they leave. So this is our metrics. The whole presentation is online. If you search AARR metrics or startup metrics for pirates, and it's all very well done and has lots more examples. Another thing this is something that is a little more complex and it's not relevant for all startups, so I'm just going to call it out as something that may be of interest to research, but it's called cohort analysis. And the idea behind cohort analysis is that you're not treating all of your customers the same. And so you're saying, and this can be done in a few different slices. So it could be over time. So it could be that, again, so if you're starting to scale up from your initial users, then your initial users are probably your early adopters, and later on you're getting more majority stage adopters who are a little more conservative, and they might behave very differently when it comes to retention and referral and how much money they spend. And if you're just averaging things together, you're going to end up with inflated revenue per user, customer lifetime value. So the idea behind cohort analysis is that you're treating every segments differently, and it could be differently based on what month they start becoming a customer. It could be that they're based on different geographies, but the idea is that you're breaking everything out and you're tracking it all separately. This is also really useful if you start, even if you're just working with the same customer segment, but you're experimenting with new ways, new tips, tricks, and techniques for retention. That's going to have a very different impact on your first users than on users that just started today. So again, you're going to want to break it out based on start date. So that's cohort analysis, and you can learn a lot more about that online too, if it's relevant for your startup. I want to talk a little bit about financial models. Let me see how we're doing on time. We actually have a bit of time, so at the end of this, I might pull out my laptop and show you some financial models I've worked on. Who here, show of hands, is familiar with basic, and when I say basic, I mean very basic, like financial statements and accounting, so an income statement or cash flow statement? Okay, cool. We have a nice smattering of hands. I definitely recommend getting base familiarity, where you can just look at a statement, sort of scan it, and understand what the main terms are. Ultimately, this is the engine that will power your startup, and this is what you need to make sure ends up working well, because having a good grasp of the financials can help you avoid serious problems down the road. And so financial models can get extremely complex, where you're modeling out on a per-month basis on a lot of different metrics, going really deep on the different parts of your business and what the revenues are and what the costs are, and how your expenses are different than your actual cash flows. But early on, you can start with something much more simple, just to get a broad sense of how much money am I spending, when do I expect to get revenues coming in to cancel that. And again, this is just a great tool, again, for understanding, well, how much cash am I going to end up needing in my business, and how much, and when do I have to raise money, and how much money should I raise? That's where this starts becoming really, really valuable. If you're in a position, and I'll pull out my laptop in a minute or two, but if you're in a position, and I'll show you some real examples, but if you're in a position where you say, okay, based on how long it takes for the payback time for our customers to recoup our money from spending them, and based on the way we think we can grow, it looks like we're going to need, $300,000 to get us through the initial spending money to acquire customers, and then after that we're going to be profitable. Then great, you can go out and raise $300,000, or better yet, raise like $500,000 because you want extra buffer, extra wiggle room. And in most startups, you're not going to raise just one time, you're going to raise many times. And so again, you can start staging out of like, okay, let me see how much money do I need until the next big milestone where I feel confident that I'm going to be able to raise money. And so terms that are good to know around this are burn rate, which is how much money you're going to be losing per month, and then runway, which is just how much money you have in advance, divided by how much you're burning per month. Tells you how many months you have until you run out of money. So every startup, the founding team should really, really know how many months do we have left, because that educates how much time you have until you need to start fundraising, and how much money you can afford to spend early on without really messing with the runway. So if you have tons of runway, you might want to hire some people earlier on that are going to increase your chance of success. But if runway is already pretty short, you want to be conserving your money so you can hopefully get to a point where you can raise again. But again, that's very startup dependent. But again, it's about having a good grasp of these numbers so you can make informed decisions. I'll pull out my laptop in a sec. Here's actually a good example. So the top chart is cumulative cash position. So it's ignoring any amount of money that you've raised in the first place, but it's looking at your net cash flow, so how much money is entering or leaving your business. And in this case, over it looks like the first 15 months, the company's actually in negative cash flow. But because of the shape of the curve, at around 10 months, it stops losing money and starts making money per month. And then you actually get to break even out at around 20 months. And break even just means, not break even, you actually recoup your initial investment around 20 months. And so the bottom chart is cumulative cash position. So that's including money that you raised in the beginning. Where are you currently sitting in terms of your cash? So this is a real example from a company I was advising where the founder had $50,000 of their own money they were putting in the beginning. And they said, OK, based on my expenses, I think that's going to last us about 4 months. And then we need to plan on raising $500,000 because otherwise we're going to keep losing money like the curve up top shows. And so in this case, based on the curve, they said, OK, we need that infusion of $500,000. We're going to keep losing money, but that'll give us enough time to get to a place where our initial investments are paying back and we can start making money, and then the cash you see goes up exponentially toward the end. So that's it. Hold on. Before we go on to the questions, let me open up my laptop and see if I can quickly show you a financial statement or two. And again, like if you can build a rigorous financial statement, that's better. But early on, there's so much uncertainty, there's so many assumptions that the extra degree of precision by having a really detailed financial model is probably not the best use of your time. But the idea is that you just get something captured, something on paper that as you keep doing more research, you can update. And this is what will show you the most glaring possible flaws with your models. One example I gave yesterday, I'll give again today, which I think is a good example of how just these simple models can be really impactful. So one of my clients was building a text message-based game. It was a choose-your-own-adventure game where they keep giving you options, and then you choose which option, and then the story continues. And so the founder was really, really excited about the idea. He was already generating the stories. He talked to customers who were really excited to play also. But what he hadn't done is build out a full model that takes into account all of the text message costs. And so I sat with him, I built the model, and it turned out, hold on a sec. It turned out that the cost of text messages were high enough that no matter how high he was charging the customer, like within reason that he thought the customer would pay, he would still make money per customer. Even if he had 1 million customers, he would still be losing money per customer. And that was really fascinating because that meant that we got to sit down and say, let's slow down, reevaluate the product, and then change how we think about the revenues. Maybe there's a better way to monetize this that will actually make the equation come out positive. Or maybe we need to change how we think about the product to make it so that there are fewer text messages, but you can still tell a good story. So again, it becomes, financial models are perfect because they allow you to, way before you run into trouble, think through what are the different options I have at play that will get me to some place that is profitable and sustainable. All right, so, okay, so let's see. This is for one of my clients I was helping out with. Oh, these were the examples I had shown you before. So here we have cash reserves. Here's looking at revenue over time. Here, I think, were different simulations for operating profit based on a few different assumptions. So another thing you can do with these financial models is copy and paste them next to each other and say, OK, well, we think our customers are going to behave in this way, but they might actually stick around for much shorter, or maybe they're only going to make half as many purchases per month. And you actually get to play around with these numbers and see which numbers really matter and affect whether you're profitable and which ones matter less. Because there's a decent chance that some of them end up being more important than others, and they might not be obvious at the beginning. And the really great thing to do then is say, okay, well, it looks like, based on these experiments, just in the model, that the number that really matters is X or Y. So maybe if you're doing a consumer-based one where it's sort of a freemium model where only a few customers are paying, but a lot of customers are using it for free, one of the key questions is virality, and that you need to grow quickly through virality. And so then if through the model you learn that virality is the number you really want to care about, then you can spend some time or some money trying to run an experiment to see what exactly is virality going to be. And so again, it's a way of focusing your energy, focusing your attention on what's really going to help you, what's really going to matter. Let's see. So you can end up building out lots of different spreadsheets that, and this was a more detailed model, so we had a really big breakout of where you're acquiring users from. So in this case, we actually had different channels, and we estimated different users coming in through there. And then that fed into a very detailed revenue model where we had free users and paid users. We also had breakouts of, this is an example of, they wanted to create a new news agency where people were creating news stories that were all audio-based. So we modeled out what's the cost per story going to be, what's the production time going to be, and so this was all important in figuring out how much we were paying people and what our costs were going to be. Here we had a customer lifetime value calculation. It was slightly more complicated than what we did on the slides, but still not terribly complicated. And so in this case, we said, okay, each customer is going to be worth 46 cents. That's after the customer acquisition cost. That's all together is going to cost, they're going to be profitable of about $0.50. And so we said, okay, well, that's good because we can now go back to say, how many customers do we think we're going to get? And is that still an interesting market? And in this case, I forget what we decided. The company didn't end up going through. They ended up changing to something else, maybe partly based on these numbers. Let me see if there are any other tabs here. So let's see. So I guess that's all the audio. That was the file I wanted to walk you through. Also, before we get to questions, I wanted to show you. Where is it? Oh, okay. So we're up here. Hold on. Okay. So up here, this is a cool article I had that had some benchmarks. So when you're coming up with some of these numbers, it's oftentimes hard to, especially as a first-time founder, to pull a number out of the air and say, oh yeah, I think, before I have any customers, I think, my conversion is going to be 10%. So a good thing to do is look online and say, what are the common percentages? This article in particular, let me get when I unplug it, I'll say aloud what the title is, but I think it's, these benchmarks can tell you how to build a good product. I'll get the full name for you. Anyway, so I just wanted to read a couple of these aloud or call them out. This is showing up oddly, so I'm actually going to unplug and then just read them aloud and add a little bit of commentary. So the first bit is the golden rule of social. 90% of people consume, 10% curate or start, if it's Reddit, they're upvoting and downvoting, or maybe they're adding comments or sharing. And then 1% are really the power users creating most of the content. So this is true across many, many different types of startups and platforms. Sorry. So you might build this as an assumption, so saying, okay, every 100 customers we get, only one of them is going to be a power user of some sort. Other ones that are interesting, so freemium conversion might be also like a 1% figure. So of every 100 free users, we only get one paid user. Let's see, is there anything else I really want to call out? Yeah, so the article here is just called "These benchmarks can tell you whether your business plan is viable." So if you want to Google that, you can Google that. There are a lot of these good articles online. They're constantly new ones because as new channels come for getting users, new technology, new ways of using social media, these numbers are constantly changing. So if you're focused on customer acquisition and even retention to some degree, the buzzword is growth hacking. So you can look up new growth hacking techniques and numbers. And again, the idea is to always approach this with an experimental mindset, knowing that the context is always changing, your customer's behavior is always changing. It's one of the really fun things about doing technology startups is that there's just constant change, and that you can go in not being an expert. You can go in saying, I don't know the answer, but I'm going to explore. I'm going to do lots of little experiments to figure it out. And that becomes really fun. And if you're doing those experiments with some great models in the background, and good conjecture, good guesses of how it's going to play together, then you can start acting with confidence and saying, okay, we're going to do this experiment because we know if we get this number, if we get the conversion rate to 30%, then our business is really, really attractive, and we can start spending lots of money on advertising. something of that nature. So I think that is all in terms of the different models I wanted to discuss, but I wanted to leave lots of time for questions. So first, let's do questions about models and things I've discussed today, and then we can expand to more broad topics of questions. So who has a question?
What is the golden metrics of user acquisition cost?
Sorry, say again?
What is the golden metrics for user acquisition cost?
Sure. So the question is, what is the
How much should we spend?
golden measure for customer acquisition cost? Like, what's a good number in general? And the answer is, it really varies. So I'll give you an example of it varying even just within like consumer targeted products, just using Google search. And so because Google AdWords is all based on demand, and it's based on bidding for different search terms, you get things such as credit cards or health insurance, where the cost per user acquisition might be $20 or $30 or even more. And that's actually not even customer acquisition. That's just getting them to click through to your site before they even start spending money with you. And so it might be that high, or if you're something that's a little longer tail or something that has less revenue associated with it, it might be much lower. It might be, you might be paying $1 for 100 users. And so it really depends on your area. There's some really good tools to use to look at Google search terms to see what you might end up paying. And also, when you're starting out, this again comes back to the bowling pin theory and saying who your initial market is. It could be that if you're targeting a customer segment that, say, credit card companies or in the US health insurance companies are targeting and spending $30, $40 to get a customer to their site. You can actually find some other way of slicing it. So you're not just targeting people who are searching for healthcare, but you're searching people who are looking for a very specific ailment. And that might actually be much, much more affordable. So another reason to segment your users. What kind of tools?
You say there's a few tools that we can actually use to
So the question is, what actual tools to use to keep track of the metrics? So it all depends. So in this case, it's one of those, the best tools are the ones that your team is comfortable using that you'll keep going back to. So I like using, for activity on the site, I'll use Google Analytics a lot. There's some other great analytics tools out there too. There's KissMetrics, who Neil gave the talk this morning. And so again, you want to look at like what is something that that's going to work for you, that you're going to be able to track your customers with. And then you just keep track of things in a spreadsheet usually. Google Drive, Google Docs ends up being great, or if you want to use Excel. I'm trying to think of other specific tools online. There are lots of little customer acquisition calculators where you can just put in, they'll ask you, oh, how much revenue per month and how much churn, and you can put the numbers in, they automatically calculate. I don't have any ones that are absolutely amazing online. You can Google and test and see which one you like. But again, I'd say start with your models being simple, and that'll give you just a good direction of, oh, do we think this is going to be profitable or not, or how profitable do you think it's going to be? And then once you're optimizing on the entire funnel, then you probably want to build a custom tool. Again, I say build a custom tool, but it's really just build your own spreadsheet that is that extra degree catered to your specific startup.
Just now you are mentioning all the time is about Google AdWords to do the acquisition. How about media buying? I think this is a much more viable way of acquisition.
Doing media buys.
Yeah.
So the question is, what about using media buys for your acquisitions? And I think, again, it depends on your market. If you think that buying TV advertisements, radio advertisements are going to be more effective, the key thing is to model it out and say, okay, let's say we're buying a radio advertisement. How many people are going to listen to that? And again, so you want to model this out. How many people do you think are going to listen to it? And of those, how many do you think are going to come through to the site? And then of those, how many of those are actually going to purchase? So you want to create that model in advance, ideally based on numbers that you've come at from other companies you've talked with. And again, this is a great opportunity. Talk to other founders out there. Entrepreneurs love helping each other out on this. And every market's a bit different. So talk to someone who probably you're not going to compete against, but who has used the similar type of media buy before, and they'll be able to say, oh, we worked with this radio station, we had these numbers, and then we worked with this TV station, and we had those numbers. So I would treat it just like Google AdWords in terms of it's just another source of users that are going to have a certain cost per user. So again, you want to be able to say, of every user we get from this, we're going to be paying X overall. So if you're paying $10,000 for the advertisement, and you're getting 100,000 users, then okay, you're paying $10 per user. And back to the cohort analysis point. These users that you're getting from media buys might be different than the users you're getting from Google AdWords. So it could be that, yes, you're getting users for $10, but they're spending twice as much or half as much. And so you want to also know about that. And also, if you can, run it as an experiment. There's a question back here. Yeah. Totally. So the question is, how do you model out these things in situations where your customer isn't the one paying? And this is a great example of a time when these simple models aren't perfect for your company, and you need to remix them. You need to recombine the models. So in this case, I would say it depends a little bit on your flow. So if you want to calculate, okay, when I get merchants online, how much you could look at it as how much money am I going to make per merchant, and then what's the cost of getting a new merchant onboarded. And so you could probably have that as just one model on its own. And then if the money only actually comes in once you have the customers, you can say, okay, well, how many customers do I need to be paying the merchants to get the transaction cut that you need? And you can still think of it in terms of revenue coming to you from the customer. You're just dividing it by. So is this like a kind of marketplace where for every purchase that a customer makes, you get 1%, for example? Is that, yeah? So in this case, yeah, so just treat the 1% you're getting as a transaction cut as the money that's actually coming in, and still be focused on the user funnel, because you're still driving users to the marketplace, and they're still converting over with the different merchants, and you're still getting a cut. And so I would still view that as direct revenue. Another example I'll throw out there that's slightly different is if you're engaging with big companies, oftentimes the person who's buying the product is not the one who's using the product, and that leads to all sorts of interesting incentives. So you might be selling to the CTO or CIO, but it's being used by sales, all the sales reps. And so again, when you're modeling it out, you want to think of, you first want to abstract it to the company overall, and you want to say, okay, well, it's going to cost us 3 sales reps working for 3 months to make the sale, and then once we're in, it's going to generate this much revenue based on these users. So again, you can still break it out as a model, and you can still use many of the techniques that the R metrics breaks in. More questions? Oh, over here. Hey.
I have a question.
Yeah.
So, looking at the financial modeling, the question is in 2 parts. So the first part, how often do you think you should revisit your financial model? Normally, I'll do it in a quarter. Yeah. And then looking at your financial modeling and your examples earlier, you're giving us 5 years projections moving forward for a company, but we thought that 5 years is a bit remote to project. So what's your take on this? And then the second part of the questions, when do you think a company or a startup should start to do projection? In the ideation stage, or during the pitching to investors, or after they get investment? Mm-hmm. Okay, thank you.
So 3 parts to the question. 1, how often should you update? 2, what's the right time horizon? And 3, when should you start? So first question, how often should you update? I would say, so if you're using something like the lean canvas and you have all these hypotheses, you want to update whenever you have new feedback on those hypotheses, or whenever you deviate from your original plan. So for example, let's say you're executing your plan, and then you have an opportunity to hire someone who's really, really amazing, and you just don't want to pass them up, but it's a little earlier than you expected, and they're a little more expensive than you wanted. You want to update your model right then, and you're going to update your model by increasing your expenses, because your salaries just went up. But you also might be able to say, oh, this new person you hired is actually going to get you, let's say they're an amazing salesperson. They're actually going to generate this much more revenue more quickly, so you want to update that too. So I view a lot of the financial models as it's your perfect window into the machinery of your business and how it's working. And just as if you were a pilot, you wouldn't want to fly blind with the windows covered and your instrumentation off, you're not going to want to run your business without a good sense of how fast you're spending your money and when you expect revenue to come in. So definitely updating your model whenever you get new assumptions, updated assumptions, or you deviate from your plan. In terms of how far out of a window you want to look, 5 years is sort of the standard thing to look out. I'm not sure how it originally became 5 years. It seems like forever when you're a startup. I like thinking like that 1 year of startup time is like 7 years at like a normal business just because it's so hectic, so chaotic. I think it's helpful to do 5 years out because again, the story you're trying to tell that you want to know yourself and that you're trying to tell investors is that we can become a huge company. And that yes, we're small today, maybe we haven't even launched, or maybe we're just getting our first customers, but there exists a world where we have tons of customers, tons of employees, and we're creating tons of value, both for our customers and for our investors and for ourselves. And so it's really helpful to have those 5-year projections because it could be that you have something that's really amazing for 1,000 users, but that just doesn't make sense when it scales even bigger. Or it could be the opposite. It could be that you have something that's kind of tough when you only have your initial 1,000, 10,000 users, but that once you hit the 500,000 user mark, then it becomes really special because then you have cost savings, or then you have extra products you can add on. And so even at the early stages, even when you're prototyping or figuring out what market to target, it makes sense to do those projections. But again, they don't have to be super rigorous. They don't have to be extremely detailed. You don't have to spend weeks gathering data for them. It just has to be enough of a sense that there is a good opportunity there. There is some really big, there's a path to something really big that you're excited about and that you can get investors excited about. There's a third part to the question, which was, or was that all of it? Right. So when should companies start looking at these models? And so I think all companies should start thinking about them very early on, and also start doing rough versions. So again, this is something that when you're really early on, you do the rough version, and then as you need it, as you mature, you do more detailed versions. So again, maybe your financial model is really simple. Your customer acquisition model is the type that I showed up here rather than the complex one. And at the beginning, when you're just prototyping, when you're just trying to get customers, and then maybe when you have a team of 50 people and lots of customers and revenue, I mean, by then you probably want a really rigorous financial model. You really want to know what your spend is going to be every month. So the idea is that you can be using all of these models at the beginning, that using these models will lead to making better decisions about what markets to enter, what features to add, what customers to target first, and how to hire. And that you want to be, this will just give you great insight and great language for talking with each other, with your founders, with investors, with talking to people for advice, because you can really articulate the benefits and the trade-offs in different approaches and strategies. More questions? Anything over here? This side of the room's been quiet. So I'll open up the questions a little more beyond just models. Other things you can ask me about. So I taught myself to code when I was in grad school. I'm happy talking about that. I'm happy talking about different techniques I use to prototype. I'm happy to talk about the journey of selling a company. Those are all different things that may or may not be relevant or valuable to the people here. So more questions? Any questions?
What would be the right background of the people? Should we hire experienced marketers, or should we be hiring fresh graduates and train them up, or
Yeah. So the question is, marketing, especially marketing for tech startups and digital marketing, is evolving so quickly. How do you think about who to hire and the right skill set to hire? So I think part of this depends on initial research you do into which channels will be most effective, because it could be that you evaluate and it turns out that media buys, that TV and radio end up becoming a great channel for reaching marketers. And in that case, you might want someone who has a lot more experience there because the techniques that you need, the skills that you need haven't changed an immense amount over the last few years. However, it could be that in your initial research, it looks like more growth hacking approaches look really good, being really scrappy, maybe doing interesting experimentation with social media. And in that case, you could try and get someone who's an expert, but they're probably going to be expensive. More, you want someone who's really smart, who understands basic principles of marketing and psychology, maybe someone who really understands your market, but also someone who you really have trust can learn quickly, can just pick up these new avenues of approaches, these new techniques, just as they're being invented. There's something really fun in it, in that you can become an expert on this stuff in just a few months because it's all so new. It's all changing over so quickly. So you want someone who's going to be really okay with the uncertainty, the ambiguity, the fact that they can't go Google the answer and that there's a clear path. And sometimes that person is someone just out of college, but that they're really bright and clever and creative. And then sometimes it's somebody who's been around for longer and really knows and understands those customers well, but is tech savvy and is willing to take chances and gambles too. More questions? Oh, how much time do we have left? A couple more questions, or
We'll have an early break for today. You have a mentoring hour at 12:30.
Okay. And what time is it now? It's 11:52. Okay. So we'll do a couple more questions. Is that okay? If there are more questions, yes.
When do you think that we can start charging the customers? Because when it starts with a freemium, right?
Yeah.
When would be the...
All right, so the question is, when is the optimal time to start charging customers? It's a really good question, and there are a lot of different theories about the right thing. So in one school of thought, you have Steve Blank, who's a very famous investor and entrepreneur, who says, charge them from day one. That you don't really know if you've built something that people love. You don't really know if you have product market fit until people are paying. And I think that depending on your situation, there's a lot of truth to that. That you can end up building a product that you have some traction, some signal around that people are using, but then when you try and get people to pay, you actually haven't created enough value that anyone's willing to open their wallet and pull out their credit card. So in a lot of situations, especially if it's uncertain, if there's no previous track record of people paying, it's really good to force them to pay up front. However, another way of looking at it is when people are freemium, when you're giving away the product early on, that's just a form of marketing. You might be saying like, okay, I could be charging them today, and that's going to cost me, maybe that'll generate $10 a month in revenue. But maybe if I give it away free for the first few months, then they're going to get really excited, and they're going to tell their friends, and the virality is going to go up. So in that case, you're saying, okay, maybe if I give the first 6 months away for free, that'll cost me $60 in lost profit, but that they're going to tell so many friends that it's okay, that it's worth it, that it'll more than pay for itself. And so again, the trick is to switch your thinking from, oh, I'm just giving it away for free, to, no, this is a specific marketing expense in lost profit, but I know it'll pay back. And again, I would only do that if you're confident that you built something that people will end up paying for. I have some friends, so I have a friend who has a software as a service company, a very simple CRM company, and they are very, very happy giving away free months as referral bonuses. And so they have a bunch of customers that now have like years of free use of the product, and they're totally okay with that because they've gotten so much more business just from the referrals. So that's definitely another way of thinking about it. I'll give you one example. With Meetings.io, we were giving away the video chat for free. But the only reason we were doing so is because we didn't want to be a video chat company. We wanted to amass a user base to test our technology so that we can build additional interesting businesses on top of it. So in that case, we were okay giving away for free because we didn't need to test if they were willing to pay. But if our goal was to become the next WebEx or GoToMeeting or paid video chat, it would have been a huge mistake not to ask for money up front, because then we really wouldn't have known if we were delivering something that people wanted to pay for, or that there's enough value that people recognize that they would pay. More questions?
From all the model that you've been talking today now, it really sellable if you're creating like a brand new product. If you want to market a brand new product. How about products that we already existing in the market right now? So how do we going to attack the market to share that piece of pie?
Yeah. So the question is, a lot of the models are up here are for teams that are trying to do something new that hasn't existed before. But how do you approach this if you're doing something where there's already an existing market? So first thing I'll call out is I'll bring up again the consensus non-consensus chart that I showed early on. And the consensus non-consensus here, I'll actually just go back to it. This chart. So I would be very careful in the first place about going into an established market unless you have a really new approach. Or something that's really differentiated. That's something that is so clear to customers that this isn't like everything else out there. And as soon as you're doing that, you can actually bring in a lot of these other models because it's sufficiently different that you can start testing these assumptions. One of the nice things about going into a market where there are already customers and competitors is you might be able to get good data on lifetime value of the customer, how much people are spending, how long people stick around. And also, you don't have to spend time educating your customers on what the product is about or what the need for the product is. So you can put an advertisement in the local paper or online or on Facebook saying, hey, do you use this product? We'd love to sit down with you for an hour and we'll pay, we'll give you a gift card for Starbucks, something like that. And so you can use it as a way of easily getting customer information. So I think most of these models are still relevant. I think this is the most relevant of all, making sure that you're doing something that's really different. Because again, like if you're coming in with something that's just a little bit better, you're going to have a really long road ahead of you. There's a model that isn't up here. I'm trying to think. Give me a sec to think if I can talk about this easily enough without drawing it out. So there's, okay, I'll just talk to it. So there's a term called, originally a book and then a theory called Innovator's Dilemma. And Innovator's Dilemma is really, really good read. At least you don't need to read the book, but just Google online to get some blog posts on the overall theory. And it talks about how new people come along and disrupt existing markets. This is one of the books that got everyone using the buzzword disrupt everything, disrupt every market. And so the idea with the Innovator's Dilemma is that you have a bunch of incumbents, a bunch of existing companies that have their product in an established market, they have their customers, and they don't want to do anything too experimental because they probably want to protect their existing revenue and they don't want to undercut themselves. And so what you can do is come in, and you usually can come in with some different technology or different techniques that allow you to have a very different cost structure, and you can come in and offer a product that's way cheaper. But the cost of doing so is usually that product is worse than the existing thing on almost every dimension. So what you do is you choose one dimension that you think you can be better on, and that is probably not going to matter to the whole market. That might matter to only 10% of the market. And you say, okay, we're going to ignore all the other customers. We're going to effectively say, we're firing the other customers. They're not for us to start. And we're going to say, for those 10%, we're going to focus on the one thing that really matters. So you might have a product that is kind of broken, that is it's really, really cheap, and only does 1 out of every 5 things that the main competitor does, but that one thing is all that those 10% care about. And that one thing you can do really well. And so the idea is that you start with this one thing, and that you do it really well, and that the incumbent, that the existing players don't even care, because they're like, oh, that 10% of the market, we didn't really care as much about them. Have fun with your broken little product. We're not threatened. And then over time, using the bowling pin model, you kind of add new features, and you start going to other customers that are in that same market, and growing and growing and adding on more and more, until suddenly the existing players are like, they wake up and they go, oh wow, you now have a product that actually is better than us on, or at least as good as us on all the dimensions, and now you're competing for all the customers. And at that point, you've come at it with a new cost structure that ideally allows you to be much more effective and win the market in the long run. So so Innovator's Dilemma is the term that usually comes when talking about how to come in and disrupt existing players, and it's well worth exploring online. Last question or two?
Hey.
Got it. So the question is, what if I create a market and the product and the market just isn't there yet? So one of the hardest things as a startup is getting the timing right. Because if you wait until it's obvious that there's going to be a market, you're probably going to be in the consensus bucket. There's probably going to be many other teams that are well-funded and working on it that are startups, and probably some big companies that are also spending money on solving the problem. So you don't want to be right on time, and you definitely don't want to be late. So then the question is, how do you know if you're that perfect bit a little too early or if you're really early? And that's really, really hard. And it's always going to be a gamble. That's one of the biggest gambles you're going to make as an entrepreneur. But oftentimes it comes from a place of deep authenticity to the space and to the problem. It comes from the fact that you've spent so much time with the customers, so much time with the different people in that ecosystem, that you know better than anyone else, like, why now is the time. There's a good sort of tool I'll use when I'm talking with people, a good framework of saying, why now? Why hasn't this been done in the past? And if the person, or when I'm looking at my own ideas, when I'm now analyzing it, and unless I can say there's been a new change in technology or a new change in social behavior or maybe in government regulation over the past 18 months that's only available now, it means that if I can't say, yes, now is the time, and previously it was not the time, there's probably a good reason it hasn't already been done. Because if it's something that's, that was able to be done 10 years ago, there were probably teams that tried it 10 years ago, and they failed maybe for interesting reasons. So I'll give a specific example. With Meetings.io, the end goal was to become an expert marketplace, so that experts in any vertical can come on and say, oh, if you need accounting advice, just video chat with me about accounting. Or, oh, you need healthcare advice, chat with me about that. Oh, it looks like you're building a web app. Like, let's talk about Ruby on Rails. And we knew that expert marketplaces had been tried many times in the past. And that every time, and usually, sometimes it was over the phone, sometimes it was via email. And what we said is there are a few things that will allow now to finally be the time that worked. Because every time in the past failed in every case except for tarot cards and like horoscope readings. That was the only case that was successful. And we were not interested in that market. But we said, we think the timing is finally right. We think that the amount of bandwidth and video technology is at a point where people are going to have good conversations and that the extra video quality is going to make people feel comfortable talking to experts. We think that more people are engaging in various behaviors online, that they're okay spending money online for a stranger to get advice. And so we sort of, that was how we sort of came to the fact that the hunch, and again, this was just the hypothesis, that now is finally the time, now the time is right. But that wasn't enough. We actually said, okay, let's figure out, it probably isn't true for all experts now, but maybe it's true just for some subset. So we started talking to different experts. We talked to we talked to some parenting experts, and we talked to families that wanted parenting advice. And we started talking to them, oh, are you comfortable talking to parenting experts through video chat? And it seemed like, oh, the answer might be yes there. And then we talked to cosmetologists, people who consulted on makeup, and their clients. And their clients said, yeah, actually for makeup, that I think the timing is right. And we talked to accounting people, and accounting people were like, oh, I kind of prefer to go in person to talk, and maybe the timing isn't right. And so we said, even the timing, we need to answer the timing question even on a specific customer segment basis. So to go back to your question of how do you know the timing is right, part of it is you're never really going to know. Part of it is you have to have some strong hunch that comes from a place of deep understanding. And part of it's going to come through lots of experiments and lots of de-risking. And so again, I apologize for people who were here yesterday because I'm repeating myself a little. But when we were sketching out Meetings.io, instead of just starting with building the expert marketplace, we started by building just the video chat, because one of the major assumptions we had was the low cost structure. None of it was going to work if we had to pay for all the video bandwidth ourselves, so we were using peer-to-peer video. So we de-risked that part. And then we started then instead of going right from there to the marketplace, we had profile pages that anyone could just create their own profile page that had a link to video chat with them. And that was great because it didn't take that much work to build. And then we can start going and reaching out to experts we knew and saying, hey, can you just try using this, not even without the marketplace, with your existing clients? And that allowed us to test those behaviors too. So again, you can de-risk a little bit of the time is right through scrappy experimentation and making sure that you don't spend too much time just building without getting feedback from customers. I think we probably have time for one more question. Yeah.
Can you just walk through an example of how do you actually evaluate and quantify a marketing strategy?
Evaluate and quantify markets that...
Marketing strategy. Can you just quantify how do you evaluate the success of a...
Sure. So the question is how to evaluate and quantify marketing strategy. And so one of the ways that we did it with the spreadsheet I had up there is we had... So first we started with just a hypothesis and a model that flowed through of, oh, we think we're going to get this many customers from free publicity, this many from inbound search referrals, this many from spent money on Facebook. And some of that was just from guesses, some of it was from talking to entrepreneurs, and some of it was from doing little experiments, so just putting $50 into Facebook and seeing how many people come through. So again, you want to use many methods to sort of come in again and try and get good numbers there. And then once you start doing your experiments, always just keep updating those numbers and keep tracking. Also, in terms of quantifying, as I said, using some kind of analytics tool to see on the ground exactly what the numbers look like. Does that answer the question, or was that?
What is the point that you can determine successful?
What is the point at which it's successful? So the question is, what's the point at which you know your marketing plan is really working? And I would say you're always going to keep iterating. You're always going to keep refining it. I mean, it's successful if I mean, you know it's a failure if you're at a point where your customer acquisition cost is greater than the profit you're making per user. So then it's really important to keep working and refining on the pipeline, or maybe that's a signal that you have to adjust your product and the way you position your product. But once you have that part working and it's just about when is the funnel finally ready and done, and when can I just put it on autopilot, the answer is never. Because there's always going to be new channels to use, new techniques to go after. Things are changing so fast now in different experiments you can run, different tools you can use to get users, that you always want to have this experimental mindset. Things are never finished. Things are never set in stone. Cool. Well, I think that's all we have time for in terms of questions. I will be around doing office hours this afternoon, and I'll be around throughout the day today and tomorrow. Please approach me. Come ask me questions. I love nothing more than hanging out with startups and talking about startups and strategy. And thank you so much for being a great audience. I really appreciate your attention and your questions. If you're interested, tomorrow I'm running a workshop on negotiations, and it would be great to see you all there too. Thank you so much. Have a great day.